Are you considering investing in stocks but uncertain about the opportune time to make a purchase? While the adage of buy low, sell high is widely known, its practical application can be perplexing. Determining what constitutes a low stock price, whether it's at $10 per share or $100, is not straightforward. However, there exist methods to assess the relative expense or worth of a stock. One such method involves using a financial metric called a multiple. This approach enables us to gauge the cost of the underlying business of a stock and detect changes in this valuation over time. In this discussion, we will explore this concept further and delve into related aspects. For instance, when you search for a stock online, such as Google, you'll encounter a range of search results along with basic information about the stock's details. This includes the stock's opening price, market capitalization, and dividend yield. Additionally, you will come across a parameter known as the PE ratio, or price-to-earnings ratio, which exemplifies a multiple. A multiple is essentially a ratio that contrasts a stock's price with a fundamental figure. Among numerous available multiples used by investors, the PE ratio stands out due to its straightforwardness and popularity. It is relatively simple to compute by dividing a stock's price by its earnings per share. Consider a hypothetical scenario. Plain Bagel Co. possesses 1 million shares traded at $30 each, and its net income from the previous year amounts to $2 million. In this case, the PE ratio is 15, signifying that investors are willing to pay 15 times the company's profit for a share. Nonetheless, the trailing PE ratio has limitations. It hinges on historical data and does not account for a forward-looking perspective. Since markets often anticipate future developments, a stock might surge based on upcoming product launches or operational improvements. Consequently, many investors favor using a forward multiple, specifically the forward PE ratio, which factors in the projected earnings for the next year. This can provide insight into a stock's value relative to its future earnings potential. While these multiples offer valuable insights, they are most effective when evaluated in context. Comparing a stock's PE ratio to its historical ratios or to those of its peers within the same industry can yield valuable information. Moreover, assessing a company's growth rate, prospects, and other factors is imperative. A low PE ratio does not guarantee a good investment, as it may mask underlying issues. Similarly, a stock with a high PE ratio could be justified if the company is experiencing rapid growth. In conclusion, multiples serve as useful tools for gauging stock value, but their interpretation requires careful consideration. While a low multiple may seem attractive, it must be weighed against a company's overall prospects and compared to its industry peers. Ultimately, thorough research into a company's fundamentals, growth potential, and competitive landscape is essential to making sound investment decisions.